Renowned investor Warren Buffett once remarked, "Don't save what is left after spending, but spend what is left after saving." To make money work for you, consider building a formidable dividend portfolio. Dividends offer safety and high yields, making them a popular choice in the financial world. This video will guide you through the art of building a dividend portfolio. Identifying investment companies, determining portfolio structure, and avoiding mistakes. It will help you create a powerful investment plan that keeps your money secure and facilitates substantial growth, providing steady income and the potential to exponentially grow your wealth. Dividends are a portion of a company's profits paid out to its shareholders. As a shareholder, you receive a share of the company's earnings, which are like special treats given by the company. If a company makes a profit, it shares some of that money with the people who own its stock. The dividend amount is typically shown as a percentage of the stock's price, known as the dividend yield, to help investors understand the amount they will receive in return. Dividend-paying stocks are often included in investors' portfolios due to their regular income and sense of safety, as companies that pay dividends are stable and profitable. This approach allows investors to outpace inflation over time, making it an ideal investment. However, expecting a safe 5% return without risk is unrealistic, as it is not possible to protect against inflation. Investors must take risks, even if they don't like it, as the risk of inflation is already present. Growth is the only way to beat it, and investors must take risks to achieve this. To create a successful dividend portfolio, start by selecting dividend stocks. Always prioritize safety first, setting clear criteria before investing. Research potential companies and wait until the price is right. If you're unsure, wait more. Say no to unnecessary risks and invest in reputable blue-chip companies with bulletproof balance sheets and yields of 4 to 5% or more. While not all risks can be avoided, choosing investments with care can help avoid unnecessary ones. Remember to look both ways before investing, as the same principle applies to investing. IBM, also known as Big Blue, has consistently increased its dividend payout for 28 consecutive years, making it one of the best dividend stocks. Despite facing challenges, IBM has managed to maintain this streak, with a 10-year dividend growth rate of 6.01%. This makes it a promising choice for investors looking for future dividend growth. Microsoft, also known as MSFT, is another company that fits perfectly in this portfolio. The tech giant has increased its dividend for 19 consecutive years, with a 10-year dividend growth rate of 10.86%. Despite a current dividend yield of 0.71%, the company has consistently increased its dividends over the past decade, making it an attractive choice for long-term investors seeking steady income growth. In conclusion, IBM and MSFT are both excellent dividend stocks with a promising future dividend growth rate of 6.01% and 10.86%. These companies demonstrate the potential for long-term investors seeking steady income growth and a consistent dividend payout. Broadcom, a computer chip and software company, has a strong track record of increasing dividends since 2010, offering a current dividend yield of only 1.54%. However, their 10-year dividend growth for the last decade is an impressive 41%. American Express, with a current yield of 1.24%, has seen a 10-year dividend growth of 10.2% in the past decade. And Apple, with a current yield of only 0.57%, has a promising 10-year dividend growth of 9.1%. Other companies investors might find attractive in their portfolios include dividend aristocrats like 3M and Franklin Resources. These companies have consistently increased their dividends for more than 25 years, making them attractive options for investors. Companies with long histories of annual dividend growth provide peace of mind as they demonstrate financial resilience and commitment to shareholders. The Dividend Aristocrats list of the S&P 500 index includes companies that have raised their payouts annually for at least 25 consecutive years. These companies, all playing key roles in the American economy, share a commitment to reliable and long-term dividend growth, despite their diverse sectors. These companies play a significant role in the American economy and can be added to your monster portfolio. Choose companies with moderate payout rates and steer clear of frequent pitfalls to make well-informed stock portfolio decisions. For flexibility in the event of unanticipated problems, a payout ratio of 60% or less is preferable. Anything more than 70% is not advised. Additionally, look for companies with a long history of raising their dividends. Many investors focus too much on the starting yield of a company's dividends, attracting companies with high starting yields. However, these companies may not always be the best investments, as they may not perform well in the long run. This is known as a value trap, where companies with high current yields but little fundamental health provide the stability of income needed. For example, a 10% current yield may seem good now but could lead to a dividend cut in the future. Verizon Communications, a telecom company with a 6.21% dividend yield, is facing financial challenges due to a large debt and declining profits. The company's earnings per share have fallen by over 20% in the last 5 years due to competition from other companies and a decrease in traditional landline phone usage. This could lead to Verizon reducing or stopping dividend payments, negatively impacting investors who purchase their stock. Similarly, Barnes & Noble, a bookselling company that used to pay over 10% dividend yield, has faced financial struggles due to competition from Amazon. They have now stopped paying dividends totally due to declining sales for 5 years, and the share price has nosedived to a fraction of what it used to be. To avoid these issues, it is recommended to focus on companies that consistently grow their dividends over time, as they tend to offer better returns and are more beneficial for investors in the long run. To maximize your dividends, consider investing in dividend growth stocks. These stocks are long-term investments, typically for retirement. Reinvest your dividends and allow the dividend snowball effect to work its magic. This can result in a higher yield on investment compared to high-yielding assets without significant dividend growth. This ensures a more sustainable investment strategy. Dividend growth stocks can significantly increase the value of an investment, making it more attractive to investors. For example, Tom's $10,000 investment in a 10% yielding stock would yield $1,000 in 1 year, but if he didn't reinvest his dividends, he would still have only $10,000 after 30 years. However, if he did reinvest his dividends, his investment would be worth $174,494, paying him an annual dividend of $17,449, or roughly $1,454 per month. This significant difference in value is significant, adding an extra $164,494. Warren Buffett's Coca-Cola position is an example of how dividend growth can be an investor's secret weapon. With a near 57% yield on cost, Buffett is earning 57% of his original investment through dividends each year, a higher cash flow return than other investors. Overall, dividend growth stocks are the secret weapon for long-term wealth accumulation. Dividends can be reinvested into the same companies that paid them, known as a dividend reinvestment plan, or DRIP. This allows you to purchase more shares of the company, compounding your investment over time. Alternatively, you can use dividends to buy shares of other companies with promising forward yields, diversifying your portfolio and reducing risk. This is a crucial aspect of building a monster dividend portfolio and is the next step in creating a monster portfolio. Diversification is a strategy used by financial planners, fund managers, and investors to manage investments by combining different types of investments in one portfolio. The goal is to achieve better returns and reduce risks by spreading out investments across various options. To diversify your portfolio, consider including 5 to 7 industries and prioritize dividend stability and growth. If dividends are cut, ensure it's not an industry-wide issue that affects all holdings simultaneously. Diversification in the stock market involves spreading investments across different companies to reduce risk. However, adding more companies to a portfolio can make it more complex and difficult to manage. There are 2 types of risks in the stock market: specific risk, which concerns individual company issues, and systematic risk, which concerns broader issues like economic crises or wars. While systematic risk cannot be avoided, specific risks can be reduced by spreading investments across different companies. Research shows that having around 7 to 10 different companies already reduces specific risks significantly. Adding more companies like 20, 30, or 40 doesn't reduce risk much more but makes the portfolio more complicated and difficult to manage. Having 10 main positions in a portfolio can provide a good balance of risk reduction and manageability. Diversifying investments should be cautious not to invest in bad industries or companies, as they can be complicated and uncertain, leading to risky investments. Cyclic industries like airlines and automobiles are highly sensitive to economic conditions, causing unpredictable dividend income. Companies with high debt levels in debt-heavy industries like utilities and banks face challenges in maintaining or increasing dividend payments due to their significant portion of profits allocated to interest payments. Competition-heavy industries like consumer staples and food and beverage demand substantial spending on marketing and advertising, reducing profits and making it difficult for companies to sustain or grow dividends, making them unreliable for dividend income. Slow-growth industries like utilities and real estate investment trusts may face limited earnings growth, limiting their ability to support rising dividend payouts. This can lead to stagnant or decreasing dividends over time. To avoid dividend traps, thorough research and analysis of these industries and companies are crucial. Opt for stable, consistent dividend-paying stocks and focus on companies with simple, stable businesses for better long-term returns. The article provides a detailed guide on creating a monster dividend portfolio, focusing on the amount needed to live cost-free and avoid financial instability. It outlines the potential earnings from one-time investments of $10,000, $50,000, and $100,000 using all stocks selected from the steps combined. The article emphasizes the importance of making investments in all stocks equally and avoiding over-diversification to avoid unnecessary complications. If you have a 30-year plan and decide to reinvest dividends back into the same stocks that paid those dividends, consider the following stocks: IBM, Microsoft, Broadcom, American Express, Apple, 3M, and Franklin Resources. These stocks have a 10-year dividend growth rate of 601%, 10.86%, 41%, 10.2%, 9.1%, 7.87%, and 8.09% respectively. By adding these growth rates and dividing by 7, you can calculate your average portfolio return of 13.3%. If Tom invests $10,000 today and reinvests his dividends, his initial investment will be valued at $423,542 after 30 years, paying him an annual dividend yield of $56,331 or $4,694 per month. This is enough for Tom to retire and enjoy a stress-free life after retirement. For a $100,000 initial investment, Tom's investment will be valued at $4,235,427, paying him an annual dividend of $563,311 or $46,942 per month. This monthly payment is enough for Tom to live a worry-free life, buy his dream car or house, travel the world, and have money left to spend on luxuries. What about a $1,000 investment or a $200 monthly investment? Can these smaller amounts still make you $5,000 a month? Comment below. Watch our next video on the dividends snowball, where we show you how you can make this a reality in the link above and in the description down below. If you enjoyed this video, do like and share this video so that more people will learn about how to build a monster dividend portfolio. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.